All right, the market's once again obsessed with the outlook for interest rates, and that's something that anyone who's investing in real estate has to think about. Could be your own home, could be investing in real estate stocks as well. And when we look at the Canadian stock market over the last year, we have seen underperformance from some of the real estate-related stocks, in part because of the new interest rate reality. We even today were talking about some of the office vacancies in a market like Toronto right now. So there have been some headwinds. What should you think about when investing in publicly traded real estate plays? Let's check in with Corrado Russo. He's managing partner and head of global securities at Hazelview Investments. Longtime real estate watcher. Nice to see you. Nice to see you. So I guess right now, for people who are investing in real estate related stocks, what is the number one thing they have to be thinking about?
Well, you hit the nail on the head. Interest rates has been the biggest headwind over the last couple of years, and it's not just Canadian real estate stocks. It's U.S., Europe, Asia, and we obviously cover and invest in the entire world, real estate companies. The biggest headwind has been interest rates. Obviously, the cost of capital has gone up and expenses have gone up, and also the overall office negativity around work from home and what that's doing to vacancy, as you pointed out. So I think those two negative sentiments have actually left us in a position where the underperformance has been so large that we're trading at all-time high discounts to where private market values are trading, as well as relative to equity markets. And we haven't seen these levels since the financial crisis and COVID. And we also saw that recovery as interest rates started to come down. That recovery started to happen over the next 1 to 2 years. So we think, as you heard from Don earlier today, as interest rates do sort of stop becoming a headwind and potentially become a tailwind as we see some cost cutting, we think that sets us up for some significant outperformance over the next couple of years.
It's interesting you talk about public versus private. Obviously, much of the world's real estate is in the hands of large, very savvy global investors. One case that was even made here on BNN Bloomberg for the real estate sector investing in it, in the publicly traded real estate names, is that you've got these big firms that are always hunting around, and if they see the value, that might be unlocked, I suppose, if the public market is not feeling they want to pay up right now. There is that looming possibility that the people that make their livelihood on this will jump in. Is that a consideration?
That's one of the biggest considerations, right? I mean, Buffett coined the phrase, the stock market just tells you what people are willing to pay today. It doesn't mean it's the value of the underlying assets. And the advantage we have investing in public real estate is that you have this massive private real estate that tells you generally where valuations are. And you've got so much capital there that's constantly looking for other opportunities, that when you see these discounts in the public market, they typically don't last very long, because those buyers come into the public market and take over these companies to look for attractive pricing. Why would you pay fair price in the private market if you can buy something on sale in the public market? So we've seen a lot of M&A and acquisitions happen over the last couple of years, and we think we're going to see more of that going forward.
Okay, you've come to the table with a few investment ideas just to give people an idea of how the landscape works. I'm going to go through a few of them. I'm going to start with an American listed name, CBRE, only because they're in the headlines this morning, because they track all the trends around what's happening in the office market. So they were the ones to say that in the Toronto area that vacancies are up. What is it about their business? I guess it reminds us that there's all sorts of real estate related companies that are publicly traded.
So think about CBRE as being in the consulting business. So you've got owners of real estate. They're trying to figure out what to do. How do I lease my property? How do I deal with vacancy? How do I improve it? How do I renovate it? How do I make it more attractive and more valuable in the future? And that's when CBRE comes in. They operate the assets for you day to day. They will help you think about where to spend capital to improve your assets so you can make it more attractive to tenants so that you can get higher leasing revenue. And at the end of the day, from a CBRE's perspective, whether the tenants leave or go, whether they pay more or less, at the end of the day, CBRE gets paid either way.
Okay. It's good. Look, bottom line, it's good to know the fundamentals of a business, even if it's more broadly speaking, associated with real estate. One of the other things that came up today was Canada's aging population, and Chartwell was an example of a name that actually recently came up on Market Call. That's a name that you're watching too.
It definitely is. Ultimately, real estate's about demand and supply, and we think Chartwell has one of the best fundamental backdrops of demand and supply. If you look at the demand side of the equation, obviously aging population, you said it, the average growth of the 65-plus cohort population in Canada is expected to be over 3% between now and 2030. The existing population growth is only 1%. So that's 3x that population growth. And at the same time, if you look at supply, because of higher interest costs, because of higher material costs, higher labor costs, the new supply of new healthcare facilities has dramatically declined by a third. So it's growing at 1% where it's been 3 to 5%. So this demand outstripping supply is setting them up to have a great recovery in occupancy and ultimately better cash flow growth. We actually expect to see their free cash flow growth grow by over 30% this year.
Aging populations is a global story. Quite frankly, our story of population growth is driven by looking around the world and seeing how other economies are dealing with it too. So it's good to talk about other markets that maybe have similar businesses. In Australia, you're tracking a company that has more than 100 retirement communities.
That's right.
Can you tell us more about this one?
Yeah, so they've got similar demand-supply fundamentals with an aging population, but what they do is they sort of are a step below the senior housing facility. So before you go to a nursing home where you need some medical support and more help, what we're seeing is an aging population, 55 plus, that wants to sort of live in these communities that offer a lot of amenities, offer an active lifestyle, the ability to share different hobbies with people that are their own age. And so we're seeing these attractive communities become a huge driver of where people want to ultimately go as they retire. They're retiring younger and they're retiring with more capital, and they have the ability to spend that capital on lifestyle. And that's where Ingenia comes in. They've got, their demand is so high that their occupancy is actually 100% today. And their growth going forward is going to be driven by, their rents are inflation protected, so they go up by the pace of inflation. And they are building over 6,000 new units on top of a base of 15,000 units today.
Wow, Ingenia is INA in Australian trading. Real quickly, we've talked a little bit about, you mentioned Warren Buffett. He started investing in Japan recently, sparked a big conversation around the Japanese market. You've been tracking a real estate company based in Japan. This is a hotel operator, a lot of properties. Tell us a little bit more about this one.
Yeah, it's Japan Hotel REIT. And effectively, we believe they're setting up for a significant recovery in the Chinese tourism. If you look at Chinese tourism in Japan, it was the largest by far driver of tourism in Japan. It's still down a fraction of where it was pre-COVID levels, whereas all the other tourism, Singapore, US, Korea, are all now greater than where they were pre-COVID levels in terms of Japanese tourism. And that's a function of, until last August, the Chinese government was still not allowing large tour groups to go to Japan. That changed in August, and that's driving a ton of traffic back. We're seeing a huge acceleration in Chinese tourists going back to Japan, and we think that this company is set up with the right assets and the right locations and the right amenity mix to take advantage of that increase in occupancy and ultimately increase in rent over the long term. So we see that as a great recovery story over the next 12 to 24 months.